Welcome to another episode of Anyone Have a Pencil? Today, my guest is Brian Boyd. Brian is an expert in asset law and tax law. So we discuss a lot about, some strategies and how you can position yourself to protect yourself from liability, how you can maximize tax write-offs. We discuss a little bit about upcoming presidential election, not who to vote for, but how you can position yourself regardless of which candidate wins to take advantage of this market, and a couple of best practices that you should be doing for your family, for your business, and for your overall tax deductions to try to, keep as much of your own cash in your pocket as possible. I think you guys will learn a lot. I know I did, and Brian is an absolute fantastic resource for anybody that wants to learn a little bit more about asset protection and tax law. So without further ado, welcome Brian Boyd.
Awesome. Brian, welcome to the podcast. How are you?
I'm good. Thanks for having me today, man. It's good to see you again.
Absolutely. Absolutely. I've actually been really excited about this. A little bit of backstory about myself. I was a 1099 W-2 guy earning, annual salary, all that good stuff. And then started my own business about 12 years ago now. And then all of a sudden got catapulted into a whole new tax category and really learning some creative ways to protect my money from the federal government really saved my butt. So, and just watching your content and kind of the way you educate people, I know it's something our clients are interested in. So if you don't mind, really quickly, before we jump in, too heavily into details, would you mind just introducing yourself, kind of giving us your background?
Yeah, sure. So I'm a lawyer. I'm from Tennessee. I went to college at the University of Tennessee at Chattanooga. Then I worked for a couple of years. Then I went to law school at Sanford University in Birmingham, Alabama. From there, I matriculated up to Georgetown University in Washington, D.C., and I got an LLM in tax. A lot of people don't know what an LLM is. It is basically a master's in tax law. From there, I got recruited by Ernst & Young to work in their corporate tax division in the DC area. So I worked there for about a year. And then I found my way back to Tennessee and eventually joined a firm here in Nashville in 2007. And in 2008, the market fell apart. So I was a transactional tax attorney, and you probably know, not a lot of work for transactional tax attorneys in the worst economic meltdown in generations. So yeah. I found myself without a job, and I looked around. I interviewed everywhere from Baltimore to Memphis, and nobody was hiring. And if they were hiring, it was for a lot less money. And I ended up going out on my own. So I was kind of thrust into being an entrepreneur. I never anticipated it. I always thought I'd be at a law firm and get a W-2, then you make partner, and you don't have to really worry about the problems. And quickly found out, oh, well, how do I'm used to advising people on very discrete tax issues, but how do I run a business? And then you get to tax time, you're like, oh my God, I owe taxes because it's not taken out of your paycheck because you don't have a paycheck. And yeah, it quickly became me falling back on my tax background to figure out, all right, how do I do this? And long story short, so between 2008 and 2011, I started picking up clients and I started dealing with their issues and kind of helping them along the way. And I have this one particular client. I saw him today, in fact, and this guy, and he's a phenomenal story. He would write me a check, and let's say it's $500. It would bounce. And I was like, dude, you're killing me. Now he writes me checks for $50,000, and I don't think twice about it, and neither does he. But along the way, he is a developer. And so I started looking at the way he develops real estate. And he would build 10, sell 7, keep 3. And then he would do a cash out refi on those, and he would put tenants in there. They would pay the note every month. The property values go up. The tenants pay down the debt. And he would just go do it again and again and again and again and again. So he currently has $70 million in assets just from that little trick he was doing.
Yeah. So
And
is he, when he's selling the 7, he's not taking any profit because he's kicking it down to pay off the construction loan on the last 3, right?
absolutely. Yep.
And then there's no realized gain there.
Correct. And then he would do a non-recourse loan. So he would only borrow up to like 48% loan to value because you
Yeah.
stay below 50% LTV. And he
I
learned that
like this guy.
quickly. Yeah,
Yeah.
it's non-recourse. And so, here we are, $70 million in assets later, and it's kicking out a couple $100,000 a month in profit for him. So, I just took that and I'm like, well, look, if we overlaid like a cost segregation study and then we break the property down into its individual components. Now, this is back in 2011. We weren't doing accelerated depreciation on under 168K. Um, but what we started doing was, okay, let's do this. Let's pay it all the way down. Then you can go back in and borrow against it and go build again because property values increase. So you become your own little bank here. And it worked out perfect. In 2015, I decided, hey, my real estate acumen is it's pretty decent, and my retirement account is not growing. So I went to my wife and I said, hey, I'm going to cash out my retirement account, and I'm going to buy something that's going to make me money while I sleep. So I built and owned a coin laundry. I owned it for 1 year. I sold it a year later and made 4x on the sale. So I took that money and I did 4 things. I bought my wife a new wedding ring, paid off a student loan, bought some shotguns because I hunt, bird hunt a lot, and then bought my first short-term rental. That rental we bought for 400. We sold it a year later for 475, and we started picking up properties. We have owned as many as 33 properties at our peak. Tonight, right now, we're like at 19, and we've gone from a monthly cash flow of 10,000 to, on a good month, we'll make 45,000 because we have short terms and long terms. But our base is somewhere between 22 and 28,000 a month. And the tenants pay the note. We cost seg all those properties. We bonus depreciate the personal property within that. And because we self-manage, we're able to achieve real estate professional status. And there we are. And so we're sheltering our income. We've got a great retirement plan in place. And now I've written a book and I put content like this, like we just talked about, online for free for people. It's on Instagram, Facebook, TikTok, and there's a YouTube channel now. So I'm just trying to educate people. You don't have to be a slave to a desk. You don't have to rely upon your W-2 job. You can go out and I know you guys in your company, y'all do this. You're like, hey, what can you afford? And you guys are custom and bespoke to those type of people to get people investing in real estate and to break away from the 9 to 5, to break away from the W-2. And
I think one common misconception about, just asset protection, tax planning, any of those things is like, that's a tool for the wealthy. It's not for the middle class. It's not for, I say this all the time. I wish I had those tools and that knowledge when I was 20, because I could have set everything up in a way that I would have avoided those taxes way earlier on. Can you kind of, explain a little bit? One, we're talking about real estate. So why real estate? Why is that a great tax haven? Why does that provide those benefits? And then, how somebody just getting started differs from, a high net worth individual that's also looking for, more tax avoidance.
Right. And so let's start with why real estate. Real estate is the number one vehicle to grow wealth. If you look at the United States as a whole, 80% of our millionaires were created through real estate. And it's everything from, hey, getting a roommate to buying your first property and renting out rooms, renting out floors. You just start house hacking, and then you go from there to, okay, well, I'm just going to rent out my entire house. I've saved enough money by house hacking. I'm going to go buy a duplex, and I'm going to live in one side and I'm going to rent out the other. And you do it again and again and again. And suddenly you look down or you look up after a couple of years and like, oh my gosh, I've got a portfolio. Yep. And the reason I like real estate is our tax policy in this country is geared to creating tax incentives for people to own real estate. If you look at everything through the tax code from section 721, 1031, Delaware statutory trusts, bonus depreciation under section 168K, the depreciation schedules under section 179, it's all there to incentivize people to invest in real estate. And the reason they want to do that is because the government is not in the business of creating housing.
Well, not right now. They're not. It seems like they might be trying to get into it.
You're right. Absolutely. Yeah. They're not right now. It might change if the election goes sideways. But the point remains is they want to reward those people that are capitalist in nature for filling a need of the American populace. And I'll say this now. I've said it many times before. There is a need in this country for affordable housing. Absolutely a need for it, whether that's duplexes or starter homes or multifamily properties. There is a need in this country, and it's a dire need. And the government is encouraging individuals to go out and invest and do that, and they're rewarding them through tax benefits. Moreover, if you do it right, and this gets to your larger point of LLCs and asset protection, you can defer capital gains and you can defer depreciation recapture, because depreciation is where the bulk of our incentives come from. And that's what shelters our income. Then I'll say that again, it's the bulk. It's not everything, it's the bulk of it. Yep. But you do that, and suddenly you buy a property for $100,000, you sell it 5 years later for $200,000, and you've got $100,000 of what you think is gain, where actually you have more than that because you've depreciated the asset. So you may actually have $150,000 of capital gains because you're going to have to recapture that. So what do? Well, you take that $200,000, the $150,000 you made, and you split it, and now you've got two properties worth $100,000, and you do it again and again and again, and you just keep rolling it. And that's how it's made. That's how you scale and how you make money. As well as I do. I know you guys are in the business of really helping out people that are needing to get into real estate for generational wealth. And the great thing about it is, generationally, this is the best vehicle for generational wealth. There is nothing better out there.
100% agree. And also, you talk about the 80% of the wealth that was made in this country from owning real estate. It's not from buying and selling real estate. Mm-hmm. It's from selling and 1031ing, or doing like what your first client was doing, which is borrowing against that asset, which is a non-taxable event when interest rates are in your favor, and using that money to either, invest in another business, buy more real estate, develop more property. Like, it's such a beautiful loophole where you can have access to the asset. It's a great store of value for your cash, because real estate typically is appreciating every year, right? And I love the idea that, yes, there is an incentive, because one thing that's happening in the country is the population continues to grow, either through, birth rates or immigration, whatever, and more rooftops need to be provided. So
that's right. Absolutely.
When are we running out of that as a demand? So it's just, NVIDIA might not be the hottest stock for the next 50 years, but real estate's still going to be required.
No, and to your point, everybody has some sort of event in your life that, hey, maybe you got an extra big tax return this year, or maybe you inherited some money, or, maybe you just decide, I've been saving money for a long time, I need to put this to use. real estate is a great way to do it. Whether it's a syndication deal, whether it's buying your first rental property. And I'll tell people this all the time: don't buy big, buy small. Yeah. Aim small, miss small. Buy that 3-bedroom, 2-bath house 45 minutes outside of the city center that's in a suburb. As long as it pays for itself in the first year, that's what you want. And then when interest rates drop, refinance it. You'll make a little bit more on it, and keep it. In 5 years, flip it, and then maybe buy 2 properties.
And we have clients that kind of run the gamut, Brian. We have people that are 5 years out of college and buying their very first investment property. We have people that are making millions of dollars a year owning their own business, or they're an executive at Google or Facebook or whatever, and they have different benefits. And one of the biggest benefits that you touched on earlier, the cost segregation benefit, as being qualified as a real estate professional. A lot of nuclear families in the United States, one of the spouses works and the other stays at home, right?
Right.
And so the income earning spouse, that's W-2 most of the time, doesn't have the same tax advantage. But if they have a stay-at-home spouse, that spouse can qualify as a real estate professional, which I believe is 720 hours a year.
It's 750 hours a year,
750.
and section 469 of the tax code dictates how it works. So typically, if it's a passive activity, it's 500 hours or more, but real estate has its own special category. So you have to work 750 hours a year in real estate, managing your real estate or being involved in it somehow to achieve and unlock those benefits. And then to your point, if this working spouse is a W-2 and you're a real estate professional, you're then going to file your 1040, and all the tax benefits are going to flow through to your Schedule C because they're active instead of your Schedule E where they would be passive. And those Schedule C benefits are going to shelter the W-2 income. So you're probably going to get a lot more money back when you file that return. And what I tell people is take that money and go buy another piece of property with it.
Yep. And do it all over again. It's rinse and repeat.
Rinse and repeat. And to your point, you don't have to be a lawyer or a CPA or a doctor to do this. You could be right out of school. And if you do it right, if you think about it right and invest in the right deals, there is no reason you couldn't be a millionaire by the time you're 30, 35. I've seen it happen.
Absolutely. What's that?
You just have to be disciplined in what you're doing. Like for me, I'm looking at providing generational wealth to my son. So, I'll get home probably around 7:00 tonight, and I'm not going to hit the bars. I'm going to get up and come back to work tomorrow. And then when I get paid, I'll put a little bit towards, here's our next down payment on our next property. And you just do it again and again and again. And it just becomes part of your life. And suddenly you look up and you've got $7 million of real estate, and it's kicking out, $250,000 a year. And you're like, okay, great. We can take a month off if we need it. And that's what a lot of people don't understand. And I think a lot of people, and correct me if you think the perception is different, but not everybody wants to be the next Grant Cardone or Robert Kiyosaki. Some people just want to take an extra vacation. They want to put their kids through college. They just want a little bit more cushion in life. And then some people on the other end of the spectrum are like, no, I want to go all in. I want to be the next Chris Crone or Carlton Dennis, or, those guys that are really up there, hitting it hard.
I think primarily what I see, one thing that is beautiful about a capitalist economy and about America is that you get paid for specialization in a field, right? So you've spent your whole life being an attorney or a doctor or a tradesman or an engineer, whatever it is, right? And you make a really good living from that trade. And the only option that you have really is to put stock money away in a 401k and then try to trade the stock market. And nobody really has an advantage in the stock market, right? There's algorithms that are trading trillions of times a second on information that you would never even have access to. So what's your real advantage? Or you could just get lucky. But I think everyone understands real estate. And most of the time, what I see from our clients, our investors is, look, I want the tax advantage. I want some diversification from the market. And I want a long-term store of value for my cash, because right now it's just sitting in the bank. It's getting eaten up by inflation. I could put it in bonds. I could put it in a bank CD, but I don't get any of the tax advantage from that. So I'd really like to learn how to become a real estate professional, or even use the Augusta rule on the short-term rentals, even on the short-term rentals in general. Can you explain that a little bit, on like how that is different from being a real estate professional? If you
Sure.
own Airbnbs?
There's this thing called the short-term rental loophole, and it's not really a loophole. It's a Treasury regulation, and it's Treasury Reg 1.469-1TE32A. And basically that says if you spend 100 hours a year on a short-term rental, managing your own rental, and that is more than anybody else managing that, you can unlock these tax benefits that are historically for the real estate professional status. And this is a very good way for people who do have that working spouse and the stay-at-home spouse to just go buy a one Airbnb or short-term rental, manage it yourselves, and offload some of the tax burden from the W-2 income by unlocking the tax benefits from the short-term rental. And you also get, everything from the depreciation to the Section 162, the Section 163 deductions that come along with it. That's respectively the business deductions and the business interest deductions. And then hopefully your short-term rental is going to be paying for itself, generating some income. So your life's going to be a little bit easier for you. And that is just one of the few components in the tax code that, people just don't understand. You mentioned the Augusta rule. A lot of people don't know about that. And it's if you want to give the background on it about the golf course and all that, I'm happy for you to do it. But it originated at the Augusta National Golf Course, where people were renting out their houses during the tournament and making a huge profit from it. Well, it became so well known, and people started doing it all across the country, that there is a provision that you can rent your house out for, I think, is it 14 days a year?
Yeah, placed in service for 14 days.
Yeah, and it's not taxable. And if you have a house in a location like that, like downtown Nashville, we have did we have the NFL draft, or was it the college draft a few years ago? And something like that. And there were places renting out for like $10,000, $20,000 a week. And you're like, what is going on? And they were using the Augusta rule. That's exactly what happened. So it's not.
Yeah, there's a lot of those fun things. And, I would encourage you, I'll post all of Brian's information here too, but I would encourage you to, get some actual professional advice from Brian if you're interested in learning a little bit more about that. One question I get a lot too, Brian, is, especially from new investors, is, do I need to set up an LLC to buy my first investment property? And, I've always kind of answered that question in a couple of different ways. One, depending on the state you set the LLC up in, like if you live in California, you set up an LLC and you buy a property out of state, you actually have to pay California state income taxes on that LLC. I might be wrong about that, but that's just what I've seen from some of our investors. There might be a loophole for that. But what would you tell a client? Like, do I need to pay the money to set up the LLC the right way? Have the operating agreement, register it, all of that stuff, even if I'm buying, $100,000 rental property and it's the only one I own?
Yeah. And to that point, I don't want people to spend money unnecessarily, but doing it right on the front end is going to save you a lot of heartache on the back end. And if you set it up properly, and don't come to me if you don't want to, but go to whomever, get the advice, talk to a lawyer, talk to a CPA, get a bookkeeper, get a real estate agent, set it up properly. I prefer certain states to set up LLCs in. And the reason I do that is experience, ease of use, charging order protections, anonymity. things that most people don't really think about when they're setting up an LLC. They'll just go to LegalZoom, like, oh, I live in Kansas. I'm going to set up a Kansas LLC. But why? Why are you choosing Kansas as your domicile for your LLC? Why not one of the more tax advantaged states like Delaware, Wyoming, Florida, Texas, Nevada, Tennessee, a non-tax state that you're not going to pay taxes in that state. They're going to provide you great protections. You go to one of the other states like New York, and you're going to pay tax in New York, and then you're going to pay tax probably in the state you're investing in. So talk to an attorney that can understand how to navigate the local state tax issues and the federal tax issues. We do it all the time, and it's just part of the way we analyze how we're going to set up a structure. For example, here in Tennessee, we have a franchise and excise tax. Well, it could be substantial. It's 6.25%. And, that's just the franchise part. That's not the excise part. The excise part is like 0.025 or something of 100 or 0.25 of 100. So how do we obviate that? Well, we have to set up a structure. And in order to do that, it's layers upon layers. And we're able to get around that tax. But you need to speak to somebody in the state, one, in which you're investing, two, in which you live, and figure out how the two different tax structures and the tax paradigms within those states work together and make it more efficient to you. Because as well as I do, 6% of your bottom line could be a lot. It really could.
That's a big swing. The other thing I think is important too is to find an attorney that understands real estate. And also understands like what your long-term portfolio goal is, right? Because like you said, you want to set that up that foundationally from the beginning the right way. I've run into this a lot of times with clients too, where, they use LegalZoom or they use their brother-in-law or somebody that's just, they're an attorney, but they're not, specialized in real estate, especially, across the United States. They're setting up operating agreements the wrong way, which can cause problems when you go to 1031 a property if you guys decide to split ways after that property is sold. Like there's a lot of issues that can be avoided if you talk to someone that is worth their salt from the beginning.
Yeah, and to that point, like talk to somebody that, look, you're not looking for a plaintiff's attorney. You're looking for a real estate transactional attorney that understands these issues and sees it every day. Just like I wouldn't go to an oncologist to set my leg if I broke my leg. That's not what he does. I'm going to go to the right doctor to do the job, as you should go to the right type of attorney. But everybody listening to this, as you look into this more and more, you also need to have a better idea of what is your goal? What do you want? What do you want your life to look like? Do you want to self-manage, or should they use somebody like your group to do everything from find the property, build the property, lease up the property, and manage the property start to finish? Just send me a check. That's all I care about.
Yeah.
Or do you really want to be involved in the day-to-day activities of property management? Yeah. I got to tell you, I've done it both ways, and there's one I prefer over the other. Right. But, it's all really, what is your tolerance and what do you want your life to look like?
Yeah. What's your time worth? Like we were talking about earlier, there's a trade-off between your time and what you specialize in the marketplace, right? So, if you can make $500,000 a year, writing code for, startup X, do you really want to spend 700, 800 hours a year managing a property to qualify? Or do you have a spouse that can do that? Or, are there some other loopholes that you can utilize, like the Augusta rule, short-term rentals, things like that. So I think that's great information. I also think the fact that, having a transactional real estate attorney that owns real estate and that continues to own real estate and acquire real estate is a big piece of the puzzle too, just because, you're more incentivized as someone that's building wealth through real estate to keep up with, current trends and changes in the marketplace and you put your money where your mouth is, which it's like you wouldn't go to a cardiologist that smokes, right?
No.
So
No.
you need to find someone who's a professional. You're going to pay a fee no matter what. You might as well get the highest representation for yourself, which is going to come from experience and actually, doing the deed that they're helping you do.
Absolutely. And, for the most part, the clients we deal with, they just want it done right. They understand there's a cost involved, and we try to manage costs, but doing it right from the outset saves you so much heartache down the road. And we get involved with your CPAs. We talk to your bookkeepers. We talk to all the professionals on your team, and we figure out, how's this going to work for you? To your other point, go to the right attorney, whether it's in your state, in this state, in somebody else's state, it doesn't matter. But do talk to the right attorney. You've got to do that. And once you have a good attorney on your team that understands what your mission is and can help you get there, the sky's the limit.
Yeah. And, watching your content and seeing what you have too, like I'm probably going to have you review my current entity structures and tell me, if there's anything that I can improve. I think it's always important to kind of challenge some of the preconceived notions that you might have had, or, I do this for a living and I still don't know everything that there is to know. I learn something new all the time. So,
yeah. And, that's something else I would tell your listeners as well is I am constantly listening to podcasts or reading an article or, watching somebody else talk on social media about something. I am always watching, and I'm always trying to enhance, that next skill set. In fact, I just finished a graduate course at Cornell in real estate investing and finance. And I think next month I'm starting an M&A course at Wharton. So constantly educating myself on how can I be a better asset to my clients, understanding the financing, understanding, how I can take them from A to Z and get them there in the most efficient way for them, and be everything they need me to be. I need to be their jack of all trades, but I also need to be an expert in this area. And so I constantly educate myself, whether it's formal education or podcasts or just talking to other real estate professionals.
I think the best thing you can have in your life is curiosity, and then like a thirst to satisfy that curiosity through, getting the knowledge in order to, offset that hole that you might have, even if it's not something that is applicable for you today. You're not doing mergers and acquisitions for large companies. So why are you taking a class at Wharton, right? Well, I don't know. I deal with a lot of high net worth people that buy companies and merge and sell. So why would I not want to be an expert? Like, I love that philosophy towards life just in general.
Yeah. And, quite frankly, these skills, they transfer over. So for example, why would I take an M&A class at Wharton? Well, instead of selling a single property, maybe my client says, you know what, I'm going to sell the entire company that owns all these properties. Sure. And then that's a disposition of that asset, that company. So I need to understand, all right, well, how do we sell the company that owns all these properties instead of just the properties themselves? Yeah. So that's one more layer. And is that more tax efficient for them? Because there are sections in the tax code, whether it's 338 G10 or 351 or 368F, there are different tax-free transactions we can do in whether it's reorganization or a disposition, we can do that. But having the right kind of attorney do that for you and understand what you're trying to achieve is very important, especially when it comes to taxes. Nobody wants to pay more in taxes than they owe.
I love that. Well, I know you're a little tight on time, so I want to wrap up with this. I saw a piece that you've been putting out on social media, and if you haven't seen it, Brian's a great follow. I would definitely recommend, following his Instagram channel, his YouTube. It's Brian T. Boyd on Instagram, correct?
Yeah, it's on Instagram and TikTok, and I think it's even on Facebook, and now I think it's on YouTube. We're putting out content always, trying to help educate people.
So one thing I've seen, and I appreciate your wanting to kind of, with some forward-looking information on what could change in the tax code based off of this upcoming presidential election. It's not an opinion on who to vote for. It's not a political stance. It's, hey, here's some of the things that are being talked about, that are being offered, and I'm just trying to educate you on what you should be prepared for. If you could kind of break that down into, maybe 3 or 4 things that are big moving parts in this upcoming election that could change the tax code. What are some of the bigger items that you think people need to be aware of? And how would you play that monopoly board if those things came to fruition?
Yeah. So the videos you're talking about, I was comparing apples to oranges there, and not using the candidates' names. I'm like, hey, this is what Apples is proposing. This is what Orange is proposing. And in that comparison, you can see that the middle class, for the most part, they're not changing the brackets. It's everything around those brackets they're changing. For example, the bonus depreciation, currently it's set to drop to 40% next year, and then 20% if the current plan stays in place. Under another plan, they want to revert it back to 100% and make it permanent, which helps small businesses. That helps the middle class. If you're an HVAC repairman or a plumber or a roofer, and you need to go buy a new truck, well, that means you can expense that truck in 1 year and take all the depreciation in 1 year, which would help offset your income, as opposed
Absolutely.
to only being able to take 60% this year or maybe 40% next year if you bought it next year. So that's the way I kind of look at these plans. Another plan is they want to increase the corporate tax rate from 21% to 28%, whereas the other candidate wants to reduce it to between 15 and 20%.
I think it was originally at 40%, right? And then they got
they
came back and said, you need to adjust it to 28.
Yeah, I mean, I was like, wow, I don't think that's going to fly. So yeah, they wanted to take it way up. And then, there's some other things that they talk about, the net unrealized capital gains. For the most part, unless you're a billionaire, that's not really going to affect you. But one candidate's not even talking about it, and the other one keeps changing, the levels of taxation on it. That's yet to be seen. There's so much more in these videos that I talk about, but I think the greater issue is, how does it affect people like you and me that go to work every day, that we're working on building wealth? Well, we have to talk about something somebody just hasn't even mentioned in these proposals, and that's what here in Tennessee we call the death tax. So currently the estate tax is set to roll back. I think it's currently set just above 10, 12 million right now, but it's set to go back to $6 million. Well, think about that. If you're a farmer and you have a big farm, your farm's probably worth at least $6 million, and that's going to be taxed upon your death. And that hurts a very important demographic in our country. So understanding these tax proposals, I think it benefits you to be a more informed voter when you go to the polls and vote. What plan is going to help you? And that's what, that video was about. I've got another one coming out on how it impacts the middle class specifically. But that's what I was talking about there. Now, I will say that one plan is supposed to be deficit or deficit reducing, or deficit neutral or deficit reducing. And the other one, doesn't matter which economist from which side of the aisle you talk to, they're going to say, hey, yeah, that's going to increase the deficit between $2 and $4 trillion over the next 10 years. However, that is yet to be seen. We don't really know specifics. I watched some of the debate last night. It was painful from both sides, and I turned it off at like 45 minutes. I'm like, I just can't watch anymore. They're just yelling at each other. But I was trying to get more nuggets out of that. Like, what are we actually talking about here? What does this really look like? Because you have people out there that say, hey, tax the wealthy. Well, if people really knew what the IRS considers as wealthy, they wouldn't be saying that. Because according to the IRS, if you're a family and you make $209,000 together,
Yeah.
you're considered wealthy.
Right.
And
you
that's
still
at
can't
a
buy a house in the United
35%
States.
tax rate. So, I mean, if you're two married people and you're working all day and you're raising children, $200,000, it's not as much as it was in 1990. I'll tell you
No,
that.
and that's a lot of $200,000, annual income earners are on the sidelines, not owning real estate right now. They're not owning a primary residence; they're renting because
Yeah.
it's expensive. So yeah,
Yeah.
I get that. So I love that outlook. A lot of people get caught up in, what's happening at the border, abortion laws, some of these like little ticky tack things. And I think because the tax code is so complicated, people just kind of gloss over that and they don't really look at how is this going to affect, my future, my family's future. You mentioned the death tax. That is a huge potential to be a massive hit. It's really a reverse wealth tax. It's like, hey, when you die, I'm going to tax your wealth and then your kids are going to get less, even though you spent, 50 years building this business or that running this farm or whatever. So I would definitely take a look more into that. I would definitely get Brian's opinion. And just real quick before we wrap up, if I'm looking to invest right now, right, given all the headwinds and things that could be going into this economy, would you, wait for this election to pass and what's going to happen? Or how would you position yourself right now? What's something you can do today that helps position you to succeed no matter what and no matter who wins in the office?
Well, that's a great question. And what I would say is if you're looking to invest today, a better time to invest would have been yesterday. Because you know as well as I do that if you buy today, that property is going to increase in value. And historically, that has been proven true year over year, with the exception of 2008. Interest rates are going to go up and down. We all know that. That's just part of the deal. But the property values consistently increase. And from a conservative standpoint, let's say it increases 3% a year. Okay. So you buy a house in year one and it's worth 100 and you buy it for 100,000. Year two, it's worth 103. Year three, it's worth 106. It just keeps going. And that's money you're not working for. That is just the market forces increasing the value of that for you. Meanwhile, the tenant is paying down that debt for you.
Yep.
So your equity position is growing.
Yep.
There's nothing better. And for me, if I was looking to buy right now, I would buy turnkey all day long. I know your group specializes in doing turnkey deals. I've rehabbed houses. It is not a fun endeavor. I would rather have brand new out of the gate, cash flow it for me, send me a check.
Yep.
I have done the self-management thing, and quite frankly, it causes a lot of consternation sometimes. And, what I would say to people is I love multifamily. Single family is a good place to start, but I love multifamily.
Yep.
It's a great place to be. It really is. And I would buy right now.
I also am encouraging people too. I mean, take a look at some, commercial spaces. I think that segment, it might not be the best time to buy it right now, but I would definitely keep a really close eye on that because, this delay and pray strategy with the banks of, adjustable rates that didn't adjust, but they're coming up to adjust again, the lack of occupancy and office and retail. It's like, dude, just sit out. This could be another, once in a lifetime opportunity to snatch some of that real estate as it goes on sale.
Absolutely. And we're starting to see defaults here at the firm. I think we're working on 4 or 5 defaults right now, trying to work out forbearance agreements with banks because inventory is just not moving at the current prices. Yep. So, what I would say is, hey, get into the market. You can't buy your second property until you buy your first.
Yep. That's true. Well, Brian, I really appreciate your time, man. And I thank you for your expertise and your education to the public. I think you bring a huge value to the market and looking forward to having you back on.
Thanks for having me. I got to jump on this call, but it's good talking to you.
Yes, sir. Talk to you soon.